CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for September 7th, 2020. Please see our disclaimer for important information. In our first chart this week, we'll revisit our COVID tracker, if you will, and I think really the key takeaways here as we look at our 7-day moving averages of daily new positives and daily new deaths is that the trend continues to migrate lower. Very positive sign that not necessarily as precipitous as some people might like, but we knew that this is probably going to be a gradual process. So nevertheless, a positive trend here. Here's a chart from the CDC that shows the testing that's going on, as well as the positive rates from the testing that is happening. As you can see, testing levels in July peaked. We did have a high-end mark here at the end of August, but the testing rates, basically the percent of positive results of the total number of tests being given, is kind of migrating down a little bit closer to 5%. So essentially 5% of all tests being given are positive, and as you can see here, we're administering somewhere between 600,000 and 800,000 tests per day. In this slide, we examine some data from the CDC, which kind of speaks to this whole issue of comorbidity risk that has been bandied about in the press for the last several months. And this is essentially of the number of coronavirus tabbed deaths, how many of those individuals have had other things going on which place them at a higher risk of infection, or in particular a higher risk, in this case, of fatality. And so the CDC, as of September 2nd, said that there was an average of 2.6 additional comorbidities recorded for each infection. And what that means is that for every infection that was recorded, there was essentially at least 2 to 3 other things that were going on with these people, which placed them at higher risk. And so I thought that this chart was very interesting, as we've seen some reports come out this week which tend to suggest that we're going to have a spike in death rates heading into 2021. But as you can see on the far left, we've had roughly 170,000 deaths related to COVID-19, but of those 170,000, 71,700 of those people had influenza, pneumonia, or some other type of viral infection. 57,502 had some type of respiratory issue, and then on down the line, obviously hypertensive disease and heart-related issues account for many of those. And when you get down to the far right, what you can see is fairly interesting, that of the 170,000 deaths that we've seen for coronavirus since this tally was started, really there's been only 10,000 of those that have had no comorbidities whatsoever, meaning that they just got the infection, they had no other symptoms, no other issues going on like diabetes or high blood pressure or anything like that. So I thought that was a very interesting statistic. This is a chart depicting the number of developed countries across the globe where cases and testing is rising. And in particular, I think, we look at the peak that transpired from April through the beginning of August, we can see that that number is going down. So we really, essentially right now, we're back to levels that we saw in March, where we only had like roughly 7 countries where the case level is rising. So another positive trend, even though we certainly know that the economic impact of COVID-19 is going to extend well beyond, well into the future. This is an interesting chart as well that I thought I would share, and this happens to kind of show the sentiment as it relates to vaccines and vaccine development out in the public domain, and it kind of tracks it from the beginning of the pandemic through where we are roughly right now. And as you can see, you see up in the top, 69% of those folks that were surveyed by the census department said that they'd be very comfortable taking a vaccination for COVID-19. And even though we've seen a tremendous amount of development and activity with regard to vaccine development, obviously it's had a very strong positive influence on the stock market and sentiment related to investors. You can see that number has gone down to 53%. And then you see the number for somewhat comfortable kind of moving up from 24 to 31. And you can also see the not comfortable percentage increasing as well. So now that's gone more than doubled from 7% to 15%. And then down below, you can see, well, if there is a vaccine, how soon would you get it? And interestingly enough, also, you can see that the percentage of the folks, and almost half of the folks originally said, I'll get it as soon as I can. And then that number has gone down to 37%. And then you can see that there's increased skepticism, if you will, with regard to how effective the vaccine is going to be, and the level of side effects and other things that are just so difficult to measure unless you have an abundance of time to evaluate this. So essentially, the public is saying that's terrific that vaccines are in development, but there's a lot that we don't know about how these are going to work, whether they're going to work, or they're going to generate side effects, and so on and so forth. So just interesting that the sentiment related to vaccines, even though it's had a powerful influence on the stock market, is not particularly profound in this case. This is the Federal Reserve commentary in their beige books, and these are regional surveys that the Fed does on a periodic basis. You can see the time frames up here in which the Fed has noted issues that are providing concerns for them in their various districts, and you can see tariffs and trade. General uncertainty has been very pervasive in their thought process, but as you can see, when coronavirus really came to the fore, you can see that remains their top concern. This chart reflects data from a survey conducted last month by the National Association for Business Economics, and it measures the percent of those business owners and executives out there that feel that we are at risk of a double-dip recession. And as you can see in this chart, that number is certainly greater than zero. This is not being reflected in what you see in the stock market, but it just lays beneath the surface. I mean, no one's really talking about the prospect of a second recession follow-on here. But as you can see here, there's, according to these folks that are surveyed, a 1 in 3 chance of going into another recession. This is a chart which kind of reflects the current status of labor, I'll say, because it measures hours worked, the number of businesses that are open, and employees working. And this is a small business indicator. As you can see, this was baseline at 0% prior to the pandemic, and obviously you can see where this thing went down in April. May, we had a bit of a recovery. June was a follow-on, but once we hit that second little mini wave of cases where we had a rise in caseload in some of the Sunbelt states and some increased pessimism with regard to the pace at which we'll be able to get through the pandemic, you could see that those trends in all of those areas really kind of level off. So the chart is entitled Main Street Health Metrics, and where you can draw the conclusions here is that we're still about 20 to 25% below where we were. And there's a lot of Main Street, as I'll call it, that is not open, that may not open, that is struggling, and these are data points that we'll certainly want to continue to monitor. This is data from a Small Business Pulse survey, and it's asking small firms when they expect business level to get back to normal. And as you can see here, there's a fair amount of pessimism in this. Now, in that green bar, though, that represents basically a quarter of the businesses that say, hey, we are already back at normal, and that's good. You'd obviously like to see that a lot higher, but you've got almost 50% down there that say that it's going to take them more than 6 months to get back up to speed. And I think that kind of dovetails with the chart that we saw a few slides ago, which kind of talked about this 1 in 3 chance, this estimated chance of going back into a double dip recession. And that's just a cautious attitude very cautious attitude that we've seen on the part of small business that we know, are continuing to struggle and kind of wrestle with business expansion issues and basically business recovery issues, and obviously the attendant labor issues that come with uncertainty with regard to the forward outlook. This is some data from First Trust, which I thought was really powerful, and we'll spend a couple of slides talking about the stock market and then get into some economic things. But this is going back to 1980, and the blue bar and the data above the blue bars represents the calendar year returns for each of those years from 1980 to 2020. Again, it's essentially a very broad set of data here, 40 years. And so you can see that within each of those years, we had some fairly strong intra-year declines. As we sit here, we look at the market activity of last month, and we had increased turbulence. We had some of the technology firms, which had been bellwether, kind of reverse course a little bit. And so I just wanted to kind of pause here for a second and kind of counsel you that, in any given year, you're apt to see a fairly strong correction. And I'd say that the last several years have been, perhaps a tad abnormal in the sense that the perception is that we haven't had a lot of volatility. But as you can see here, over a 40-year period, we've actually had a lot of intra-year volatility, and oftentimes that results in a market that's entirely positive. And just, if you go look, obviously in 2008, the trough of the market, we had a 49% correction, and the market was still down 38% for the year. But by the same token, you can see in different years, like say in 1980, we had a 17% intra-year correction, but the market was still up 26%. And there are data points like that all over the place. And you look at the last 3 years, in 2018 we were down 6%, but we had a 20% intra-year correction. In 2019 we had a 29% gain. It was a great year, but we still had a 7% downdraft. And then obviously this year with the pandemic, this is a little dated, so the S&P is actually up for the year to date 2020, but as of this is data as of June 30th, and the market was still down at that time. So just the key takeaway here is that we may well see intra-period corrections of size, but I don't want to have you believe that when we see that we need to panic. And if you remain steadfast in investment allocations, you can see that more often than not, you're going to wind up with positive outcomes for the end of the year. This is just reflective of what we've seen over the last week. We've seen a rather dramatic increase in volatility. A lot of this happens to be centered in some of those areas that have been outperforming over the last several months. So natural to see some kind of correction or kind of a pause in some of those names, but overall volatility, at least over the last 2 weeks, has really begun to spike. This is representative of the FANG stocks and the rest of the S&P 500. And so we've been talking about this leadership gap and the fact that we've had relatively narrow leadership in the market. And this is kind of illustrative of that. So you can see that, basically the change in the FANG stocks, or that group of stocks that has really led our market. You can see that in market value, we've had increases in multiple expansions for forward price to earnings, trailing price to earnings, forward earnings, and also trailing earnings. I mean, we've had tremendous growth in all of those categories for that narrow group of stocks that has led our market, and consequently has given us a bit more volatility here over the last week. But as you can see, and really the key thing on the far left is the market value bars. If you take away the FANG stocks, or this group of 5 or 6 really powerful large market capitalization firms, that the other stocks in the S&P 500 index have actually gone down in value in total. We had a chart that kind of spoke to this last week. So it really speaks to this leadership issue that, if you subtract out this narrow leadership, that, we've actually had a decline in market value even though we've had increases in price to earnings, but we've also seen the forward earnings estimates for those folks, the remaining members of the S&P 500, actually go down. This is a busy chart here. It's put together by Scotiabank and republished by Bloomberg. And I thought it was interesting because it goes back, and looks at historical bear markets and the recoveries out of those bear markets dating all the way back to the Great Depression, all the way back to September of 1929. Again, they're fairly momentous occasions that are reflected in this chart. And you can see that in the years following the bear market, you can actually have some really strong years, and you can actually have some really strong follow-on years in that second year following the bear market. And obviously, we've seen a lot of turbulence here this year, and we probably had, as you can see down at the bottom, we had a 1-month bear market in February of 2020 that more or less ended after the trough in the market at the end of March. But so essentially, we've had a 56% gain in, I'm not exactly sure when this data point was captured, but in any case, we've had more than a 50% gain from the trough from that bear market, that 1-month bear market earlier this year. But as you go up and look at all of these different bear markets, kind of dating back to 1929, you can see that the average 1-year post-bear market return is 46%. So, if you look at this one as representative of what's happened in the past, it's very consistent that we've had gains. Obviously, as it relates to the prior slide, we really want to see those gains be better distributed amongst the remaining members of the S&P 500 and not have that 56% gain come from, basically 5, 6, 7 of the 500 stocks. I wanted to highlight this chart that comes to us by way of Bank of America's quant strategy team. And this just, this is really a teaching point that I want to deliver, because most of our clients have longer term investment horizons. And really what this says, and there's some statistical backdrop to all of this, but basically the variability of returns, the volatility of returns over longer holding periods, like when you get past 5 years, and especially 10 years, that essentially you get to like 80% of the volatility of returns is explained by price to earnings. And what that means is that valuations do matter over the long term. And so as we look at valuations in a lot of the rest of the S&P 500, again, to the slide that we just looked at, a lot of the S&P 500 is down for the year. Valuations have increased, but earnings estimates have come down. And so we've had some narrowing of leadership amongst these ultra mega cap stocks. But if we can focus our efforts and find those companies that have lower valuations, that there's this strong relationship on long-term returns will lend itself to better performance over time. So as we sit here and we add more portfolio insurance into and downside protection in the market to protect us on the downside, it gives us an opportunity to reinvest that investment or portfolio insurance, if you will, when valuations do go down a little bit, that's going to have a very strong influence on positive returns over the long term. We'll take a little bit of a quick peek here at manufacturing. Again, manufacturing is less than 15% of the economy, but we've had a rebound in the Purchase Managers Index, which is good. It's above 50, which means it is clearly in expansion mode, so we want to continue to see that. We look at a couple of commodity indicators. We know that lumber prices have gone up tremendously. You can see that on the left. But we've had a little bit of moderation in lumber prices under the November contract, so that's good, that's healthy for the construction industry, certainly the home building industry, which we know has been super hot lately, iron ore, which goes into manufacturing and whatnot. So those prices continue to go up, which are cost inputs into manufacturing, and so we'll clearly want to monitor that as it relates to production cost inflation, etc. Crude oil production, we know, has been down, and we know that it's been impacted by prices. This is just illustrative of the fact that we're sitting here in hurricane season, and Hurricane Laura provided another downtick in terms of oil production, which, again, depending on how you feel about OPEC Plus and their ability to control prices, that if you have less supply and you're selling more inventory out of your storage, that it should have a positive influence, at least during the interim, on oil prices. We've got a couple of charts on trade here. So this is just a kind of indicative of the fact that we have had, we've meandered a bit on trade, and you can see that the impact on global trade was first impacted by some of the tariffs and some of the trade disputes between the U.S. and China, and that both on the goods trade balance as well as a service trade balance, which is perhaps more important for the U.S. Because we are a service-based economy, that we've had some fairly strong downturns in that. Obviously, we'd like to see the service balance at least pick up if we can't have the goods balance indicators pick up, but we can clearly see that both areas of trade have been impacted in a meaningful way this year. This is our trade balance excluding petroleum, and this is as low as we've seen it in almost a generation. Very strong downdraft, and again, this is not something that has happened overnight. We were witnessing some weak trade, weakness in our trade balance for a number of years, and it only was exacerbated by the trade disputes with China. Unemployment, well, a brief comment here. You can see regular benefits are actually going down. The overall level of claims for unemployment may be tracking down slightly, but you can see that the regular benefits are being replaced by the PUA, or this Pandemic Unemployment Assistance, that is permeating through. And we know that those types of assistance programs are going to go away, and so you can see really the takeaway here is that you have it illustrates the millions of Americans that are dependent on this type of assistance right now, and have been, frankly, since April. And as these programs go away, that you're going to see more strain on millions of Americans. A couple of comments on gold here. We've had some charts on gold. We know that gold has, it spiked and it's corrected a little bit. It's having a banner year because low interest rates and real negative interest rates with inflation expectations perhaps beginning to perk back up based on what the Fed has told us in their meeting in Jackson Hole. But having said that, if you look at gold prices and emerging markets, which is another area of interest for us, so I'll give you kind of 2 in 1 in this slide, that emerging markets have been somewhat of an enigma. However, a weak dollar, which we've certainly had this year, should ordinarily be very good for emerging markets equities. And on the left, you can see that there's actually a fairly strong historical relationship between gold prices and emerging markets. And we haven't seen that this year. It's been very unusual. So, push, we'll have to, push will come to shove at some point, and you have to, you'll likely see some kind of convergence into some, average there, because it's just unusual to see how oil and EM go their different directions. But having said that, I thought I'd put the chart on the right, which kind of gives some perspective to folks out there. This is data over 60 years, more or less. And so it shows the number of outcomes in kind of what I'll call this histogram here, which shows the number of outcomes for gold at different return levels. And so, if you look at that large spike in the middle, there's basically 19 years where gold returns have been anywhere between -5 and 5%. So on average, just call it, essentially no return. That out of 60 years, roughly, a third of those, gold has really done that much. And 16 occurrences there, you can see that gold has actually gone rather precipitously, anywhere between -5 and -40%, and that's offset by a preponderance of occurrences on the other side, which show that essentially roughly 16, 17 times the market return in gold has been anywhere between 5 and 20%. So really what this tells us is that gold itself has a preponderance of going up, but gold can be quite volatile, both on the downside and the upside. But as we sit here and we're having a banner year in gold, that we know that emerging markets should dovetail with that, and they just haven't done that yet. We do have an EM allocation, again, emerging markets allocation, which we think will be positively influenced here. A quick comment here on the whole China issue, and there's a lot of rhetoric out there now, and not much of it is positive, and it is arguably a very strong risk factor for the market. And what this chart really highlights is just the simple fact that it's going to be hard to disentangle ourselves with China, just to say that we're going to pull up our tent stakes and move on, because sales of U.S. Firms and affiliates in China, again, these are sales of U.S. firms in China, continue to go up, and so how do you disentangle that, and without having destructive influences on a lot of U.S. companies? And as you can see down below, that exports goods and services to China are going down. We know that imports from the U.S. to China are also going down. So we know that net trade is going down, but we have a lot of U.S. Interest in China with regard to sales, as well as Chinese firms in the U.S. and that number is going up as well, although that data comes to us at a bit of a lag. So it's going to be hard to disentangle trade with China looking at this data. And the other thing that we have talked about with some interest over the last couple of years is, amidst this trade spat, what's going to happen with Chinese holdings of U.S. Treasuries? Because we do know that China has a large U.S. Treasury holding, as you can see here, that essentially about 1.1 trillion now, but that number has gone down. So this whole notion that China is going to go out and sell their treasuries, I mean, it's not a new phenomenon. This has actually been going on for a number of years as China is diversifying its currency reserve basket. And so, China continues to sell treasuries on a fairly consistent basis. And finally here, we want to talk about the budget deficit, and this I thought was a really interesting chart from the Manhattan Institute, which shows the impact of COVID legislation on the deficit that we're expected to have this year, roughly 4.2 trillion, and how that plays out over the ensuing next decade. As you can see, it does have an influence. You can also see in the blue part of that bar that the baseline estimates were that based on current programs in place and the visibility of and longevity of those programs that are in place, that the budget deficit was going to continue to rise. It's only exacerbated, particularly in 2020, 2021, by the COVID-19 legislation. And as you can see in the out years that we have the 2017 tax cut extensions, if they are extended, I think there's a lot of debate as to whether that's going to happen. And most, I think people feel that a lot of those extensions or that legislation will be allowed to sunset in a few years, that also provides an influence on this as well. Well, that'll do it for this week. Hope you've enjoyed our charts of the week, and we'll be back again next week with some of the more interesting things that we find in our daily reading. So please feel free to reach us at the information provided. Have a good week, and have a safe week, and we'll talk to you again very, very soon.